Boy, take three. I'm getting a late start on this one, but I'm not going to miss two in this week. I said that I wouldn't, and so this one is going up tonight. Uh, Pending home sales are out. I believe these are existing homes, and it was down something like 4.4%, I think. Actually, I just double checked. It was 5.45% year over year. And so this is for February, meaning that we are 5.5%. Pending home sales are 5.5% lower than they were in February of 2021. Excuse me, I'm a bit drowsy, so if I hesitate, it's not because I don't know what I'm talking about. Now, with that said, I don't know what I'm talking about. I'm an idiot. But I think I know just enough to be dangerous about the housing market, geopolitics, and monetary theory. Because it doesn't make a dummy to look at mortgage rates and to see that mortgage rates are now at their highest since, I believe, like May of 2019. And that's not saying a whole lot, considering that, um, back then, I think we're very much still in the housing bubble at that point. But the point is, mortgage rates are moving in the wrong direction. In order to continually blow an asset bubble, interest rates have to continually decline. And the problem that we've been having in America since the last decade or so is that we've been bouncing off the zero lower bound. And the Fed can't be any more accommodative, especially when we've got near double-digit inflation. We're getting there. We're probably going to hit double-digit inflation at some point, even by the warped modern CPI interpretation. Now, if you use the old shadow stats, it's around 15% or so. And so, yeah, the Fed, they can't very well be cutting rates at this point. And even if they wanted to, they don't have any rates to cut. They're at zero. They're now at 0.25%. They're at 25 basis points. So 0.25%. But they still need to keep hiking because they're nowhere near the rate of inflation. And, conventional wisdom is interest rates are supposed to be positive in real terms. You want your interest rates to be above the rate of inflation. But hey, mortgages are still a good play. If you're the one going into debt, because mortgage rates are below inflation at the moment. They are negative in real terms. But as we know, that's not enough to continue to push housing prices higher and to continue to increase the volume of home sales. Now, a lot of people are going to say that pending home sales keep dropping because volume is dropping. And I didn't look at the housing inventory because I believe National Association of Realtors does publish stats on housing inventory, how many houses are for sale at any given time. So I can't say for certain that they are going down. They might have plateaued. But putting that aside, the expectations of the panel of economists or whoever, I guess it's Reuters normally that does these things, or maybe it's the National Association of Realtors themselves that puts out the estimate. They estimated that it was going to be like a slight gain, I think like 0.5% gain in pending home sales. So they're taking all of these other factors into consideration. The people who are making these estimates, while it's fun for people like me to beclown them when they're wrong, they're not just flying by the seat of the pants. They are looking at other data to try and forecast what these numbers are going to be. And so when pending home sales disappoints to the downside, that's not a good sign for the housing market. Okay? So at that point, you have to start looking at things like mortgage rates and say, gee, is there a reason why pending home sales disappointed to the downside? Does this little thing called the mortgage rates, did they maybe have something to do with that? And when we look at the trajectory of mortgage rates, are they moving up or are they moving down? Is this, if this current is the source of the unexpected weakness in the housing market, do we expect that if the weakness in the housing market is a symptom of these mortgage rates, do we expect them to be going up in the future or down in the future? Well, considering that the Fed is just now beginning their tightening cycle, which is supposed to rein in inflation, the answer is that we would expect these mortgage rates to continue to rise. And so it is quite possible that we have seen the peak in the housing market. If we're already seeing weakness in housing, now it does take, for sales, prices will keep creeping up because of expected inflation, things like that. People are still going to be listing their houses at exorbitant prices until you really start to see a decline in sales and houses start sitting on the market longer. We're not at that point yet. We're still at the point to where realtors, and I know this for a fact, are putting offers in on homes before showing them to their clients, and only going to homes that they have offers in on. That's backwards from how the real estate market normally works. Normally, if you're a realtor, you have clients who want to buy a house. You go out and you show them a bunch of houses, and the clients think about it, and they go, gee, you don't like house hunters. You know, they simplify it, and they only show like three houses on the show, and then they go, you know what, I like house number 2. We're going to put an offer in on house number 2. And then they write the offer, and they submit an offer to the sellers, and the sellers think about it, and they say, I guess we'll accept your offer. Now it's the reverse. Now, if you were, let's say, watching House Hunters, well, let me think of a real hot real estate market. Miami's not so hot. House Hunters of Naples or something. That's a real hot market in Florida. Or Cape Coral. I think Cape Coral is the hottest. And by hottest, I mean like most bubbly. If you're watching House Hunters of Cape Coral, you would see these prospective buyers put an offer in on 3 homes, and then they'd go look at those 3 homes, and they would wait until they somehow miraculously get an accepted offer, which is pretty unlikely that they would get an accepted offer unless they are a cash offer, or unless they are like, 5 to 10% over asking price at the very, very least. And then if they do get an accepted offer on any of those 3 homes, they're going to go ahead and go with the purchase. Doesn't matter if it was their favorite or not, because you can't afford, you don't have a choice at this point. And so when the housing market is that heated, it doesn't take much for the housing market to cool. When you're at the point that buyers are putting offers in on homes and then looking at them, you can only go down from there. That's more insane than 2005 by far. And so you see, anything less crazy than the crazy that we're witnessing right now in the housing market is technically a decline. Even if the housing market is still extremely hot, it's still a decline relative to where we are right now. And once that decline starts to set in, let's say a lot of these investors, these people who, I think George Gammon pointed this out in his video, which, if you're interested in the real estate market, George Gammon did a real good real estate video a couple days ago on his channel. He made the point that investors, your institutional investors, have been chasing yield and moving into housing. And this is something that I've talked about ad nauseum, although not recently, but I've talked about it a lot on this channel, about how investors chasing yield into housing because they're saying, if I will pay whatever for a house as long as I can make a 5% return in rent. And if you look at housing prices in a lot of areas, the price will actually reflect that. If you were to take what you could get, which you theoretically could get in rent for that house, and multiply that by 20, so you take the annual rent. Let's say you could, to make it simple, let's say you could earn $10,000 a year in rent on that property. Multiply that by 20, you'll get the price $200,000. That's probably what it's going for. And the reason for that is that investors are chasing yield. They'll do anything they can to make 5%, because you can't make 5% in financial markets, at least not on fixed income. You can make 5% in stocks, but stocks, they have their ups and downs, and the gains are in equity, not in interest. And so as interest rates rise and the yield on financial assets, like junk bonds, goes up, and as the real estate market starts to slip even ever so slightly, even if it's still an extremely hot market, if it starts to slip a little bit and the yield on bonds starts to come up, you're going to see a rotation on the part of institutional investors out of real estate and back into fixed income instruments. And this is going to accelerate the decline. And and George Gammon gives a very good explanation of this. I would cite one of my own videos where I've explained it in the past, but it's been so long now, I never remember the titles of my videos. I never go back and reference my own stuff. It's easier to reference something from somebody else that's more recent. But anyway, this rotation is something that we didn't see so much in 2005 because we didn't have big institutional investors. What you had was speculators. You had people buying houses, trying to sit on them for a couple months and then flip them, like Zillow. But of course, Zillow has already gone not bust, but they've gotten out of that ridiculous scam. But I don't remember this phenomenon of big institutional investors buying up single-family homes and just wanting to rent them out for the income. I'm sure it existed, but not to the extent that it does today. And there are other investors, smaller time people, like I said, hedge funds, smaller funds that are doing this. I notice they've also been doing it with service companies. I have talked to people in service in the service industry, people who are have retired or are thinking about it, and they're not looking at selling their company to like a bigger company that's a competitor of theirs. They're looking at selling their company to some kind of hedge fund or group of investors who want, the essentially to earn a yield, who want the annual income from that business, because these are businesses with clients who pay monthly, and those monthly payments for their services are like interest. And so these guys are able to get a ton of money for their business because these big investors are looking at it as, hey, I'll pay you what I need, or I'll pay you whatever so for me to earn like 5%. Because then if they're making 5%, that's better than, a junk bond. That's a better dividend than you'll get on, stocks. If you buy, a dividend stock ETF or something, you're going to get what, like 2%, 3%, maybe? I don't know what dividend. I mean, it's well below 5%, whatever it is you're getting from like a dividend stock ETF. And so that sort of investment behavior will cool off too as interest rates rise. And remember, the Fed has only hiked rates 25 basis points, and we're being told they're starting to, warm people up to the idea that the next rate hikes are going to be 50 basis points. And we're already seeing housing start to slip. We're seeing mortgage rates spike. Mortgage rates not too long ago were in the 2s. Now they're in the 4s. That's a doubling. When mortgage rates are that low, increasing by 1 or 2% is huge in percentage terms. You're doubling. If you're doubling the interest rate, that is radically reducing the purchasing power of people who need financing to buy a home. And if you are reducing the purchasing power of people who are getting financing, yes, a lot of the people who win the bidding wars, most of the time, the people who win the bidding wars are paying cash. But remember, a lot of those cash buyers, big investors who are going to rotate out of the real estate market if they can get a higher yield somewhere else, or if they can get the same yield or a better yield with a more an easier instrument like a bond. So you'll have less of those kind of cash buyers. And the other thing is that without the competition from the people who need financing, the cash buyers are not going to have to offer as much, because they're not. So even though they're winning the bidding war, they are still having to compete with those financed bids. And so if the people who need financing can't compete at all with the cash buyers, well, the cash buyers are going to offer less money. The cash buyers are only going to offer as much as they need to overcome the buying power of the finance folks. And by finance, folks, remember, I'm not talking about like people in the finance industry. I'm talking about people who are getting a loan to buy a house rather than people who are paying cash. And so even though the people getting loans are not the ones winning, they are still helping to push prices higher. And so all of these factors point to housing prices declining, not increasing. Third, another thing that I missed, is this the third thing? Stocks. When the Fed raises interest rates, stocks are the first thing to fall. They move fast. And a lot of these people, these cash buyers, are able to pay in cash because of all the equity appreciation in their stock portfolios. They're able to sell some stocks, rotate into real estate, and get some more steady income. If stocks crumble, which of course is associated with rising interest rates, all these other things. It's a lot of times this is a chicken or the egg thing. If interest rates go up and stock prices go down, first of all, you also have the flight to safety thing. You have the rotating out of riskier into less riskier assets because of like bonds because of the rising interest rates. It might not be a direct causal link between stocks falling and real estate prices going down. Although I tend to think that that in this environment we're going to have a stronger causal link, but it could just be the same thing because, well, stocks are obviously going to go down at the same time as real estate because they're being influenced by the same factor, which is the interest rate. That's what this comes down to at the end. That's the most important thing, is the interest rate. Interest rates are the most important price in any economy, and I know that might ring less true now than it has ever at any point in the history of my channel. Even though I've consistently said it because of what's going on with the oil markets, it's kind of the conflict between, okay, well, what's more important, controlling money or controlling energy? And right now, it looks like controlling energy, might be the better bet. Because that's it's Putin versus, the American idea. America thinks, oh, well, as long as we control money. Well, the problem is America doesn't have as good of a control over money as they think. If they did, then yes, it would be. Controlling money would be more important than controlling energy. But when we're talking about the domestic U.S. economy and financial assets in America, interest rates still reign supreme. That is the most important thing to our economy. Interest rates inform not just how much you'll invest, but where you'll invest, how you'll invest. Interest rates determine the structure of production. It's a very old lesson that that we learned from Mises and Hayek. Those were the first guys to write about it. I say, Mises came up with it first, and then Hayek expounded upon it. So I give them both credit, even though Hayek, for some reason, is the one who won the Nobel Prize for it, like a year after Mises died. I'll put it this way: the Nobel Prize being somewhat of a sham is not a new phenomenon. The pettiness of the people who select, who's going to win the Nobel Prize, that's been pretty consistent throughout its history. But you know what? There's going to be a lot of chicken or the egg questions in the next few months, because we are sliding into a depression that I think is pretty uncontroversial at this point. And so there's a lot at play pushing us in that direction. And so it's easy to come up with, there's plenty of potential culprits for what will cause all of these problems. And now I don't think of declining real estate prices as a problem. I think that that's a great thing. Housing, I've been railing at this for the entire history of my channel. Housing is criminally unaffordable, and it's artificially unaffordable. But housing prices move slow. They're slower to move up, and they're slower to move down. And I think I've gotten off track a bit talking about different things tonight. But I still question how far the Fed will take this. The pain in the stock market will be felt long before we see a real decline in the housing market. And so that begs the question, will the Fed stay the course? I think that the obvious answer is no. At some point, they will stop. I think it'll be well shy of 2% because the market started to implode back 4 years ago once the Fed got, I believe, to 2.25%. And typically, the max of a Fed tightening cycle is half of whatever it was last time. And considering that the Fed backtracked in 2018, they might be able to get to more than half. They might be able to get over 1% because they didn't, it wasn't a full cycle. They didn't take their medicine and go into a recession back in 2018 like they were supposed to. And so maybe they'll get to like 1.5% on the Fed funds rate. But by the time we get to 2%, I mean, it's hard to think that there will be much left of America. So much of this country depends on the stock market. And I believe the housing market is a part of that. I think that the housing market is largely a product of the stock market. And so, I've said this in the past, I think that inflation can come down without the Fed actually having to hike interest rates to where they are positive in real terms. In other words, back in 81, we had double-digit inflation. Volcker raised the Fed funds rate to was it 20% itself? Or did the 10-year get to like 20%? I can't remember exactly. But either way, Volcker raised the Fed funds rate above the rate of inflation. That's guaranteed to kill your inflation. But I think that the Powell Fed doesn't even have to go that far. Because the goal of the post-08 Fed policy was to inflate a stock bubble, an asset bubble, in order to encourage consumption. And so the asset bubble is what's fueling consumption. You've got home equity loans. You've got people who are spending, money by selling off their massive stock portfolios. All these things. And so, as that wealth evaporates under the pressure of a slight increase in the Fed funds rate, up to let's say 1%, 1.25%, 1.5%, the purchasing power of I don't want to say the average American, but the average upper crust American, the average American who actually has assets, their purchasing power is going to be so greatly reduced that we could see inflation actually come under control with the Fed funds rate at 2%. Because the wealth that these people have, what's pushing their consumption, what's enabling their consumption is so fragile, it can all easily fade away. Now, with that said, Jerome Powell has made it abundantly clear in the past he doesn't want let stocks to go. He doesn't ever want to let stocks go down on his watch. I've been talking about that again for years. Every time we get to the point where we could have a real stock market crash, Powell comes in and says, not on my watch. But I don't see how inflation can be brought under control without taking down the stock market. The stock market is a major source of consumer price inflation at this point. So which will he choose? Does Powell even understand this? I don't know what the Fed is thinking. I mean, I've told you, my only personal experience that I've had with someone at the Fed, and they were a very high-level official. They were a voting member. I'll put it that way. And I've said this in the past. I will never give the person's name because I don't want to trash people. I don't want to trash someone and give their name. But they basically revealed, I think that's making it sound too grand. He just told me they pretty much fly by the seat of their pants. The Fed does. They screw around with the Fed funds rate They go, it's like they're taking a screwdriver and they're screwing with the air fuel mix on their carburetor. It's something that I was doing today, so it's an apt analogy for me. It's at the front of the brain. And they're turning that screw. They don't know which way, they don't know where that screw needs to be set. And so they're just, turning that screw and seeing, okay, is the engine running a little better? Let's fatten it up a little bit. Okay, let's see. Oh, no, that's starting to flood it. Okay, and they turn the screw back the other way. It's that simple for them. They start changing the Fed funds rate when there's something wrong. And if it makes the engine, meaning the economy, run worse, they stop and they go back the other direction. And if that creates more problems, then they stop and they start moving back the other direction. It's that simple. Now, their definition of what running well means is very different from what my definition is. And that's, again, part of the problem. You don't necessarily know what the Fed's goals are. Is the Fed's goal to continually increase asset prices? That's been their goal for a long time. But is their goal now actually to fight inflation? Or is it both? Because these two goals are in conflict with each other. That much is clear. We can't have high asset prices and low inflation anymore. They tried that. They told us it was transitory for so long. They closed their eyes. They hoped it went away, and inflation's only gotten worse. And so they have to choose. And so far, the Fed is telling us, they claim, they've chosen to fight inflation. If they've chosen to fight inflation, that means that they're also fighting asset prices. If the Fed really wants to fight inflation, that means we're in for a crash worse than 2008, because every crash is worse than the last one, because every crash, or every bubble, is more unstable than the last one. Every bubble is bigger, because they have to replace each bubble with successively bigger bubbles in order to try and cover up the damage of the last bubble popping. So, with that said, I will see you folks back here tomorrow.